You can always count on Senator Levin for some theatrics, but what we want to know is what, if anything, Congress should do about high-frequency trading. With us here in New York, our friend Sal Arnuk. He is the co-founder and partner at Themis Trading, and Kevin McPartland, who is head of market structure and technology research at Greenwich Associates. It may help, Sal and Kevin, for Senator Levin and Senators McCain to draw attention to high-frequency trading and raise questions about conflicts of interest. But should Congress be stepping in here?
Well, I'll jump in if you don't mind. First of all, I think I think Kevin will agree with me. We're very pleased to see this debate move away from high-frequency trader good, high-frequency trader bad, and into the much more meaty topic of there are some serious conflicts of interest embedded in the complex system we trade stocks.
Or whether there are. At least asking the question.
But there's, there are issues around order routing, and I think it's very telling that the title of this panel starts off with conflicts of interest. And the debate has definitely shifted there. It's shifted there. Anyone who's familiar with Attorney General Schneiderman's investigation knows that it's really focusing on broker routing, order routing behavior. Mary Jo White, in her speech last week, and Kara Stein, numerous times in speeches, Commissioner Kara Stein, referred to the conflicts in order routing, and it seems like they're all telegraphing, and here we are, Senator Levin, telegraphing that we're on the same path.
My question is, do regulators really understand what the business is all about anyway? I mean, in reading Flash Boys, one of the things that stood out to me is nobody knew what this industry was really about.
Yeah, I mean, I think there's two sort of main thoughts I have on this whole debate. Sal and I agree on some of them and disagree on some of them. I think by and large, investors are better off today than they were 20 years ago, and we can talk about that more later. The market is, though, most certainly too complicated. There's no question. And I think you're right. I think market practitioners have a hard time understanding. I think the regulators do have a pretty good grasp at this point, right? They've been looking at this since, what, at least 2009, 2010. We've been examining this deeply. Congress, on the other hand, is, they're sort of a little more of a step-back approach. They've got bigger fish to fry, quite frankly, in the U.S. and the U.S. economy, so I'm not sure how much they are into the nuance. But I think the core thing people need to take away from this is, yes, investors are better off. Yes, we can trade online for $6 to trade, but the market is way more complicated than it needs to be, and we should try to do something about that.
Real quick, Alex, if I could jump in. I do believe that Congress has really stepped up their game, and if you look at Senator Levin's history, he has a history. His staff members, Ty Galosh, is the senior advisor under Commissioner Kara Stein. Commissioner Kara Stein was, a very close integral part of Senator Jack Reed's team, and Jack Reed and Senator Levin have both been delving into this for years. So what's interesting is that you do have the right people who are really well versed. They know what's going on in the broker routing. They know what's going on in the conflicts of interest, and they are in positions of power now. So this is not your run-of-the-mill congressional market structure panel looking into high-frequency trading. His thumbprint is certainly felt in the SEC today.
Well, what gets me a little frustrated, though, right, when we get to Congress, is it's very political. It has to be, right? That whether they like it or not, they're politicians. So it's about what's politically viable as opposed to what's best for the marketplace. Now, if we had an ideal world, I'd say let's close the equity markets for a month. Let's scrap everything we have today. Let's all get in a room like J.P. Morgan style.
Before the midterms, right?
Before, and don't let anybody out until we come up with a solution that everybody likes, and let's start all over again. And then we'll
like a union negotiation.
That would be, I'm thinking like J.P. Morgan in the 20s when they locked everybody in that room and made them agree on the way forward. I think that would be a great way to take this.
Both of you gentlemen are familiar with an op-ed published in the Wall Street Journal by a former hedge fund manager named Andy Kessler, who I think proposes a very elegant solution to this problem. Reg NMS, which the SEC drafted in, 2005 and put into practice in 2007, is widely acknowledged to be the source of the perceived problems in computerized trading. And he says it all comes down to two words: best price. Why not change best price to best execution? Do you agree?
I agree. Very interesting. When you look at, and I really enjoyed reading Mr. Kessler's op-ed, what's interesting is while we have just such a marvelous market structure to trade 300 shares of Bank of America 16 times a year, if you're the average investor at home trading through your Ameritrade account where the order never even sees an exchange anyway, if you're most Americans who have their money in 401k money and 401k funds and mutual funds and index funds, those orders tend to be, T. Rowe Price or Fidelity or Putnam's buying, 800,000 shares for in a pool for everybody. And this market structure, with all the timing differences between all these different pools and all the technology differences, there's a lot of built-in arbitrage and unwanted touching and unnecessary.
Oh, here he goes again. Sal confusing high-frequency trading with teenage dating. Wow. I'm kidding.
So there's a great, I don't mean to bring it back to the topic, I apologize for doing that, but there's a great parallel in Europe, right? When you look at Europe's rules, which mostly fall under MiFID, right? They talk a lot about best execution in Europe. They give a lot of they give a little bit of freedom to the brokers to help their clients decide what is best for them. And I think it does make a lot of sense. The best, and this is true in other markets, it's true in the bond markets, it's true in the swaps markets. The best price is not necessarily the best.
Help people to understand, though, exactly what you're talking about. The way I understand it, and correct me if I'm wrong, is if I'm, let's say, T. Rowe Price, and I'm putting in an order for 100,000 shares, maybe that's a lot, but 10,000 shares of IBM, let's say, and the best price is available on 100 shares of IBM, and that's posted by some high-frequency trader. If I execute or even try to execute at that price, I've exposed myself because I then subsequently have to place additional orders to fill out my 10,000 shares, whereas I might be better served if I could just buy 10,000 shares at a slightly higher price.
Well, let me make it even.
Is that more or less?
Let's make it even simpler.
Simpler.
Let's make it simpler.
I'm all for that.
Let's say if you have 2 online accounts and you want to trade 10 shares, and you can get you can buy the shares a penny cheaper from broker 1 than you can from broker 2, but broker 2's commission rate is lower. So what's the best execution there, right? It's the one with the lower fees and the higher
Doesn't that leave it open to too much interpretation and create its own issues down the road?
It does, and if I can, I want to, because Kevin seems to be focusing on the small investor issue and taking into account the true explicit cost of one particular trade. When you're trading hundreds of thousands of shares, that's broken up into child orders. So it's not as simple of the 100 shares of IBM that's offered. What does the broker do with that 100,000 shares as it's routed and put into an algorithm? Does it go sit in the broker's pool first? Then does it try to bid on a high rebate exchange? Let's tie this back to Senator Levin's debate. There's a panelist on that, there's a witness on that in that hearing named Robert Battaglio, who is a professor at Notre Dame and who's done work on showing how, depending on which exchange you go and bid for a stock, the outcome and the execution for the client is vastly different, given the same exact NBBO at the time. So is the broker routing all of these child orders, splitting the 100,000 shares up? Is it sending it to the right proper exchange where it's most likely to get the best and cheapest price for the an investor or not?
Very quickly, Kevin, Andy Kessler raises another important point in his op-ed from the Journal, which is this, that Wall Street wants to get paid. And one of the reasons that the system has evolved thus is because the way that it used to get paid kind of disappeared with the introduction of Reg NMS. And so trading firms and operators of dark pools, et cetera, have introduced frictions in order to get paid somehow, right? This is what Michael Lewis complains about, the scalping that goes on. If it were fixed in such a way that there was best execution, wouldn't the street want to get paid in just another way? In other words, we'd end up paying the same amount for trading, invisible or invisible. Maybe we just know it better.
Right. I mean, this isn't a group of nonprofits, right? They need to make money somehow. I mean, we're already seeing in our research that the model is evolving a little bit in the way that they get paid. Some of the bigger banks are focusing more on their electronic offerings, which are lower margin businesses, but they don't need as many people. And then you'll see some of the sort of the smaller brokerages where they're focusing more on the other side. They're looking, let's high touch, let's provide better research, and clients are willing to pay for information, right? Especially with markets this complicated, clients want somebody to help them understand how they navigate the markets. So yeah, absolutely, people need to get paid. Now, sort of on that note, and this takes us back to Congress a little bit, do we need more regulations, or do we let the markets sort of sort this out themselves? If IEX is the answer, then the market will go there and the volumes will move that way. If the market's not terribly upset, things will continue on as is, right? So I almost
Fair
feel like
point of
there's a
view.
free market solution to the whole problem.
And I surprisingly agree with Kevin. I think
Every once in a while.
every once in a while, I think the best solutions are not going to come certainly from Congress. I do believe that there needs to be a rules of the road, if you will, that comes down from our regulators, from the SEC and from FINRA. But outside of that, you have IEX with an interesting model. Market share is increasing even in this environment. NYSE, Jeff Sprecher, and Tom Farley, who's also on that panel, is changing the way they view their responsibility in the market as being more for to facilitate investing rather than short-term trading. Things with all this scrutiny, the wheels are moving.
Market-based solutions for a market. Who would have thunk of that? Sal, great to see you. Sal Arnuk, Kevin McPartland. Thank you very much, Kevin from
Sal.
Greenwich. We're going to be back in a